Have you ever wondered how the world's largest economy was brought to its knees in just a matter of months? What caused millions of Americans to lose their homes? Why did some of the world's biggest banks suddenly collapse? And why did the U.S. government have to spend $700 billion just to prevent the entire financial system from falling apart? The most surprising part is, this crisis wasn't caused by a war. It wasn't caused by a natural disaster. It all started with home loans. But how did ordinary mortgages trigger a global financial collapse? If you want to understand how the 2008 financial crisis began, who was responsible, why millions of people lost their jobs, and what lessons the world learned from one of the biggest economic disasters in modern history, then make sure you watch this video until the very end. Part 1. America before the crisis. To understand the crisis, we first need to go back to the early 2000s. After the dot-com crash and the September 11th attacks, the U.S. economy slowed down. To encourage spending and investment, the Federal Reserve lowered interest rates. Borrowing money became cheaper than it had been in years. Banks began offering mortgages to millions of Americans. At first, this seemed like a good thing. Families who had always dreamed of owning a home could finally afford one. Demand for houses increased rapidly. As demand grew, home prices climbed year after year. Many people believed one simple idea: house prices will never go down. That belief became the foundation of one of the biggest financial bubbles in history. Part 2. The housing bubble. Imagine a house worth $200,000 today. 1 year later it becomes $230,000. Then $260,000. Then $300,000. People weren't buying homes just to live in them anymore. Many were buying simply because they expected prices to keep rising. Some investors bought multiple properties. Others borrowed heavily, expecting future profits. Banks were making billions by issuing more and more mortgages. The entire housing market appeared unstoppable. But beneath the surface, a dangerous problem was growing. Part 4. Risky home loans. Banks wanted to issue as many mortgages as possible. So lending standards became weaker. People with low incomes, poor credit histories, or unstable jobs were still approved for large home loans. These were called subprime mortgages. Normally, banks would avoid lending to high-risk borrowers. But during the housing boom, they believed rising house prices would protect them. Even if someone couldn't repay the loan, the bank could simply sell the house for a higher price. As long as home prices kept rising, everyone believed there was little risk. Part 5. The hidden financial machine. But here's where the story becomes much more complicated. Banks didn't keep these mortgages. Instead, they bundled thousands of home loans together. These bundles were converted into investment products and sold to pension funds, insurance companies, banks, and investors across the world. In other words, the risk spread far beyond the United States. Investors believed these products were safe because many received high credit ratings. As more investors wanted these investments, banks issued even more mortgages. The cycle kept growing. Part 6. The bubble burst. Around 2006, home prices stopped rising. They started falling. Many homeowners suddenly found themselves owing more than their homes were worth. Some simply walked away. Others could no longer afford their monthly payments. Mortgage defaults increased rapidly. Every unpaid mortgage reduced the value of those investment products. Banks around the world suddenly discovered they were holding billions of dollars in risky assets. Part 7. September 2008. The crisis reached its breaking point in September 2008. One of America's largest investment banks, Lehman Brothers, filed for bankruptcy. The collapse shocked global financial markets. Investors panicked. Stock markets plunged. Banks stopped lending to one another because nobody knew who might fail next. Credit markets froze. Businesses struggled to borrow money. The financial system was on the edge of collapse. Part 8. The government steps. The U.S. government realized that doing nothing could trigger an even deeper economic disaster. Congress approved a rescue package worth about $700 billion. At the same time, the Federal Reserve cut interest rates to nearly zero. It provided emergency funding to banks and financial institutions. Several major companies received government support to prevent a complete financial collapse. These actions were controversial. Some argued taxpayers were rescuing Wall Street. Others believed the rescue prevented another Great Depression. Part 9. Impact on ordinary people. The financial crisis wasn't just about banks. It affected millions of ordinary families. Millions of Americans lost their homes through foreclosure. Millions lost their jobs. Businesses closed. Retirement savings declined sharply as stock markets crashed. Around the world, countries entered recession. Governments launched economic stimulus programs. The effects of the crisis lasted for years. Part 10. Lessons learned. The 2008 financial crisis showed how deeply connected the global financial system had become. A problem that started in one part of the U.S. housing market eventually spread across the entire world. It reminded governments, banks, investors, and ordinary citizens that rapid growth built on excessive borrowing carries significant risks. Following the crisis, financial regulations became stricter, banks increased their capital reserves, and lending standards improved. While no system is completely risk-free, the goal has been to reduce the chances of another crisis on the same scale. Conclusion. The 2008 financial crisis didn't happen overnight. It was the result of years of rising home prices, risky lending, excessive borrowing, and overconfidence throughout the financial system. One assumption, that housing prices would always rise, helped create one of the biggest economic disasters in modern history. The crisis reshaped financial markets, changed banking regulations, and affected millions of lives around the world. Understanding what happened in 2008 isn't just about looking back at history. It's about recognizing how financial decisions today can influence the future. If you found this video helpful, don't forget to like, subscribe, and turn on notifications for more easy-to-understand documentaries on global finance, economics, and world events. Thanks for watching, and I'll see you in the next video.